The Laundry is proudly produced by Strise, your AML automation software for faster onboarding, smarter monitoring, and growth without overhead.
That's why we're compliance first as a business, because we're seeing the next wave of adopters, and they're going to have very different standards to the original adopters of stablecoin.
Welcome to The Laundry, the podcast connecting AML, compliance, and financial crime to the real world. Right now, two powerful forces are on a collision course. On one side, you have the world's biggest bank and payment giants racing to adopt a new form of digital money that promises to make global finance instant, cheaper, and available 24/7. On the other side, you have global regulators and financial crime experts warning that this type of technology is becoming the new frontier for sanctions evasion and money laundering. That's why everyone, from big banks to payment providers, treasury departments to crypto enthusiasts, are watching a very specific bill moving through the US system. A bill that could very well shape the very fabric of our future economy. A bill that could bring stablecoins into the mainstream.
As lawmakers work to try to understand what cryptocurrency even is, efforts to regulate it are already underway. Last week, in a bipartisan vote, the Senate passed the Genius Act. It creates this regulatory framework for stablecoins. Okay, what are stablecoins, you may ask? Stablecoins are a type of cryptocurrency that's value is pegged to an alternative asset like the US dollar or the price of gold.
While crypto often carries the Wild West label, these fiat-backed tokens are presented as a more stable alternative, acceptable to the traditional financial systems, merging innovation of the blockchain with the traditional banking system. But hold on, this is still crypto, and that Wild West element has not been tamed just yet.
The defining feature of stablecoins versus other types of cryptocurrencies is that they claim to be backed by reference assets such as the dollar or another currency. However, without proper transparency, this only provides the illusion of stability for stablecoin investors.
I'm your host, Fredrik Riiser, Head of Strategy and Business Development at Strise, and in this episode, we are asking, what happens when stablecoins go mainstream? We'll be discussing the current status of stablecoins, the financial crime challenges they pose, and what mainstream adoption could mean for compliance professionals. To dive into this topic, I'm here with Chris Mason, CEO and co-founder of Orbital. Chris founded Orbital in 2017, a payments platform that orchestrates stablecoin and traditional payments for global businesses. Orbital raised 5.8 million euros back in 2023, and prior to his work in stablecoins, Chris held leading roles at Citigroup, AIB Merchant Service, and Worldline. Welcome to The Laundry, Chris. Excited to deep dive into stablecoins and compliance with you. So first off, what gets you out of bed in the morning and excited to work in this industry?
Thanks, Fredrik. Thanks for having me on the show. I think getting out of bed in the morning's a difficult thing for me, actually. I think going to bed's the more difficult thing. I tend to work very, very late, and then that makes it difficult to get out of bed. But I think on a serious note, yeah, I think what's happening in stablecoin is probably solving the biggest problem in payments worldwide today, which is cross-border payments. I think a lot of domestic schemes are out there, they work very efficiently, etc. But I think, stablecoin is really the answer, I think, to cross-border payments or more efficient cross-border payments, whether it's, speed, cost and friction are the things that payments people like to look at. So yeah, it's very innovative and it's an exciting space to be in. And as we all know, there's a stablecoin frenzy out there in the market. So that only increases my motivation.
And to set the scene, what are stablecoins and how are they typically used or leveraged?
Very simply, stablecoins track generally the US dollar. Most of them out there are US dollars, but they can track other currencies. There's multiple banks in Korea at the moment, or plans to issue a stable coin that tracks the Korean won. But in general, their history has been that they track the US dollar, and 80% of the world's trade today is done in US dollars. Thus, the kind of take up for US dollars has been much, much greater. But in essence, it's a type of cryptocurrency that works on the blockchain that tracks the currency of choice, let's say.
Now the Genius Act is passing through the US system. But besides this, we have also seen a lot of interesting movements elsewhere over the last few months. France's SocGen recently became the first major bank to launch a dollar-pegged stablecoin. JP Morgan is launching its alternative to a stablecoin called JPMD. Fiserv has launched a bank-friendly stablecoin. And Circle, one of the world's largest issuers of USDC, went through a bumper IPO recently. So as someone who's been working in this space since 2017, why is so much happening right now?
I think there's a huge amount of FOMO out there in the market. I think obviously people are seeing the issues with, say, SWIFT for cross-border transactions. I think a lot of the stablecoins frenzy, I think is maybe overhyped. I think there's a misunderstanding sometimes of what problem is really being solved by a stablecoin. So I'll give you an example. If it's a SEPA-backed stablecoin, are there huge problems within Europe with SEPA transfers? Are there problems with devaluation of the euro? Not really. So I think an awful lot of the schemes out there that are being launched by the banks, I'm not entirely sure that they're kind of necessarily solving a problem. But I think, obviously USDC or USDT, where there's, a decent amount of liquidity around the world. So you've got a buyer and a seller. And then that enables those coins to change hands very, very easily. Whereas I think a lot of the bank-backed stable coins, there's a lot of ingredients missing before they're really going to solve a problem. But I think certainly, most banks in the world now have a focus on it, but maybe there's some confusion about what problem they're actually solving.
And that type of confusion with the speed of development, are things happening too fast now all of a sudden?
I don't think so. I think that, some things are not happening fast enough. I think, regulation is catching up fast. We've talked about the Genius Act just come out. It's been a long time coming, shall we say, for the US to really take a position. You'll see a lot of emerging markets that are still working out what to do. They've got currency controls, they've got all sorts of, different things to consider. So I think things are going relatively fast from a regulatory point of view. But I think, probably on this podcast, we'll talk quite a lot about education and the fact that there's an awful lot of compliance people out there that really need to be educated around stablecoin. So yeah, it is happening fast. And I think, the compliance and regulatory world and the banking world need to really, really kind of catch up. But there's a lot more transactions. Some of those transactions are not happening through the right places. They're happening through unregulated entities or might have light registrations. So just to repeat, would happen through light registrations as opposed to a fully regulated institution. So, there's transactions happening between private wallets and things like that, which could be subject to scrutiny, I suppose, that aren't necessarily supported by a regulated financial institution. So there's definitely pockets of the industry that are questionable, but I think basically the industry's going in the right way. And, the regulation is catching up. I think standards are catching up, compliance people are catching up, banks, etc. But it's going pretty fast. And I think everyone's running to keep up, I would say. But I don't see anything going particularly in the wrong way. I think it's just, this kind of improvement of the general, all the players and all the people that kind of tend to sit in the stablecoin industry. So who knows?
We'll delve into that further into the conversation as well, because I do have a couple of questions regarding that. But I also wondered, Orbital is focusing on having a very much compliance first type of approach. So elaborate a bit. What does that mean? Like in a day-to-day operations perspective, How does that affect the operations and how you think about your products and educating the market and so forth?
I don't think we're that different to say almost, like a major institution in the traditional currency space. I think, most crypto firms have started from a long way back. They don't necessarily have management team that have that experience with AML and all the compliance things that go with it. So, I think many firms are catching up in that regard. I think our reason for being compliance first is, you talked about it in the intro, really, that I think there's a perception out there around safety of the industry and security. And, the next wave of stablecoin adopters, such as, the big commodity firms or logistics providers or marketplaces or places like that, they want to feel safe. And I think safety comes with, computer security, client segregation of funds. Everyone knows what happened with FTX, etc. AML needs to be absolutely spot on. So from a customer point of view, it's becoming more and more important to the next wave. And I think we're well placed to satisfy the standards of major businesses. But then equally, you will not get a strong banking relationship unless you've got your act together. So you have to get traditional funds on and off your platform. So we all need banks. We all need regulators. So, when you look at the people that you have to satisfy to be a successful business, to regulators, banks, customers, even staff members, staff members want to see that you're running a good shop and it's reliable. So that's why we're compliance first as a business, because we're seeing the next wave of adopters, and they're going to have very different standards to the original adopters of stablecoin.
You feel there's a lot of vendors in the market or platforms in the market that haven't adopted that type of standard to have a compliance first approach and sort of see sort of the next frontier or next evolution of this, where that will be an expectation to really do business?
Yeah, I mean, I think a lot of people would see the compliance piece as a kind of like a necessary evil. We have to do this kind of thing. Whereas we would see it as, if we really embrace this, we digitize everything, people, processes, technology, policy, etc. I think there's a lot of firms who have said, chosen to take a very light registration in somewhere like Poland or somewhere like that, or Spain or somewhere. And that doesn't really come with an awful lot of obligations, as opposed to, a very robust license, such as somewhere like Gibraltar or a MiCA license or something. So I think it can be a little bit misleading for the market to say, people are saying, well, we're regulated, when it's really a light registration that has very little obligations or audits or anything like that. So I think there are players in the market that are maybe not operating to the standards that, this next wave of adopters or banks will find acceptable. But I think they're getting found out pretty quickly. Things like computer security standards and, needing to have ISO 27001 or SOC 2 or something like that will become a norm. And then that will push out the guys that really haven't got the funds or the know-how to really, really deal with that. So I see it improving. Yeah, see it improving.
Very good points. We can't look at this topic and not talk about the financial crime challenge of stablecoins. So the skepticism and inherent volatility of crypto has been able to mitigate some of the risk, because it's created friction for the criminals in terms of going from crypto and incorporating that into sort of the traditional fiat economy. It's also been quite unreliable due to the fact it has quite high fees. There's uncertainty whether or not, even with sort of more disguised transaction to Ether and so forth, whether or not there's actually tracking possible on the blockchains that could be reproduced in the future. And then lastly, just the fact that it is volatile means at some point it might mean you had a contract which is worth a lot today, and then 2 years down the line where you're actually getting paid, those cryptos aren't worth anything anymore. However, stablecoin will fix a lot of those issues. That makes it potentially even more attractive for the criminals. A recent report by Chainalysis found stablecoins to account for 63% of crypto-based illicit transaction volumes last year, taking dominance away from the traditional sort of Bitcoin approach on that end. Founder of Evira Money was charged for processing payments of Tether, which is known as the most commonly used stable coins for criminals, and one of the very big ones as well. And that was regarding some transactions approved to Russian clients linked to blacklisted banks. And the UK central bank released a statement saying stable coins as a form of sound money falls short. So how do you react when seeing stories like this?
I think the first point to make in terms of stablecoin representing 63% of illicit transactions is that stablecoin has become the crypto payment method of choice as opposed to volatile coins like Bitcoin or Ether or XRP or whatever. So it's no surprise that stablecoin would be taking the lion's share of illicit transactions for sure, because, Bitcoin is really an investment product today. People trade it, they try and make money on buying and selling it, but they're not using it as a transfer of value. I think the second point is that there are illicit funds running through the traditional currency institutions, the banks all over the world. I don't believe statistically, I believe that illicit transactions are still way below 1% from a stablecoin standpoint, which is not that different from the traditional currency world, shall we say. So, there will always be illicit transactions running through systems, and it's about how you control that and how you prevent that happening, really. And I do think that the blockchain will give you that additional information that the traditional systems don't. You only ever really see one transaction back on Swift or something like that. On blockchain, you can see an endless number of transactions back to see whether transactions are being layered or who's paying who and all of that. And so I actually believe that stablecoin on a blockchain is far safer, and you get far more information to control that financial crime.
Because if we flip the conversation on its head, like you mentioned now, there are plenty of data points you'd be able to gather, and especially historical data points regarding multi-layered transactions tying back into bank accounts and so forth, that poses a lot of positives when it comes to solving challenges within compliance and mitigating the risk of illicit actors getting access to the economy. Other sort of inherent compliance challenges that are fundamentally better solved by stablecoin adoption?
Yes, I think so, Fredrik. I mean, when you look at the fundamentals of financial crime, you have who's doing a transaction, who's behind it, who the counterparty is, the substance of the transaction between those counterparties. So those are the basics, and they're no different in the stablecoin world, versus the traditional currency world. I think what you get in the stablecoin world and through a blockchain is, you can go indefinitely back through the blockchain to see who's paid who or whatever. We saw a transaction recently that had 29 hops away. But those 29 hops had been executed by a bot, and they'd gone from one wallet to another, and you could see that it was 100% terrorist financing, transaction. So that in the traditional world, if you were a terrorist, just for argument's sake, and you were to pay me, and then I was to pay someone else, someone would not be able to see that you'd paid me. They wouldn't know where my money had come from. Whereas with a blockchain, you can see all the way back. And, the more sophisticated players now, there are lots of data providers out there that are manipulating data and looking at data. And, you can then start to hone in on, is there a problem with this wallet or this player? And, they can see, enormous amounts of patterns. So certainly from a blockchain point of view, it's so much more effective than a Swift system. And I think that's why you're seeing a lot of governments, issuing CBDCs, and I think that's one of the reasons why banks are thinking this could actually solve a lot of our problems, because we're all spending more and more on compliance resources and systems, but are we actually getting more effective?
Thank you for the insights, Chris. We'll be right back shortly with what the future looks like if stablecoin goes mainstream. So don't go anywhere.
Strise turns KYB from a costly burden into an automated winner. But don't just take my word for it. Let's hear what one of Europe's largest payment companies, Vipps Mobile Pay, has to say.
In the olden days, there were people sitting there Googling the company name, all the brand names, the CEO and so on. I think they used more effort into the process than evaluating the outcome, and that's what I'm looking for. I would say Strise definitely helped us improve our productivity. So working more efficiently, working more risk-based, automating repetitive processes, and by this helping us, of course, to decrease costs, but also improve customer satisfaction. Being able to make low-risk decisions automated without long waiting times, that's of course extremely important. Strise, one tool that works in all our markets, that we are able to collaborate, to have streamlined processes, to have optimized processes, to have one tool, one source of truth that is collecting all the input from a lot of other sources, so you don't need to open 3 different tools, but everything consolidated in one place. Either you are part of the scalable automation game and work risk-based as everyone else, or you will not survive the competition. Strise is really helping us realizing those ambitions and goals.
Explore the AML Automation Cloud. Visit strise.ai for more information.
And welcome back, listeners. Great to have you back. So, Chris, so far we've discussed what stablecoins are, the rising momentum, and the inherent challenges they pose. So let's move the chat on to the mainstream adoption and its opportunities. If we look at the Genius Act currently passed through in the US, the bill promises to protect consumers and set industry standards, which could allow crypto coins to become a mainstream tool. How will that fundamentally change the stablecoin space?
Good question. I think it's difficult to know right now. 80% of stablecoin transactions happen outside the US, and that was primarily driven by emerging market, local currency volatility and devaluation. So, you take examples like Argentina or Nigeria or Turkey, where they've got inherently unstable currencies, and people would rather be in stablecoin. And then that was the first step, and then the next step was to start using it for payment. I think the US has notoriously been quite behind in terms of innovation. Well, they're still processing 11 billion checks a year, which I find completely mind-blowing. And the fintech industry, no disrespect to the US, is nothing like as dynamic as it would be in Europe, for example. So it will be interesting to see how the US businesses, because they're still issuing lots of checks as well, by the way, it's not just consumers, but it will be interesting to see how they might start to adapt. ACH in the US is open 23.5 hours a day, I think, but closed at weekends and things like that. So maybe people will start to transact in US dollars domestically. But I think all eyes are on what happens overseas and whether US companies will start to embrace paying in USDT, for example, USDC, as opposed to paying in US dollars and waiting for SWIFT, basically. So I think the major impact would be that the US banks will start to become far more crypto friendly. And I think that will help the stablecoin industry, let's say, to get funds on and off the platform, because we see stablecoin as a payment rail, as opposed to necessarily, a payment instrument in itself. Some people will want to just work in the stablecoin world, but very often, people want to on and off ramp into traditional currencies, either end of the transaction. So I think the US banks will become important. Well, they already are super important because, everyone has a US dollar clearer. But, if US banks become more crypto friendly, then I think that will really accelerate global use of stablecoin, because you're able to get funds on and off the platform.
You also mentioned Nigeria, Argentina, Turkey. We also have seen India, Indonesia, Brazil adopting stablecoins to hedge, like you mentioned, hedge towards sort of their local currency, local fiat economy, because they don't trust the system. How do we then build a system where these type of economies can venture sort of outside of their local domain and enter the mainstream finance with all its positives in terms of global trade and so forth in a compliant manner?
I think the first thing for most of the emerging markets, not all, is to develop regulation in the way that the US is doing and has already happened in Europe and UK, for example. So I think there is some regulatory uncertainty there, and a lot of these markets are still trying to work out what happens with their capital controls. But, I would argue that the capital controls actually create instability in your local currency, and I think that's almost been proved. So, people see stable coins, say, as a kind of leaky bucket, let's say, against capital controls. People buy it, they sell it overseas, etc. So there's a lot of regulatory advancement that needs to happen, I would say, in a lot of these markets. Some are there already, some aren't. I think that's probably the major barrier. I think, then local banks will follow and become more crypto friendly. And then your liquidity in those markets would increase. So if you're a commodities broker like Glencore or a company like Glencore, there may not be enough liquidity in the market to buy and sell, even with Tether, which has a huge capital value today. So I think regulation is one of the first steps, and then I think things like liquidity and the banks falling in line is the next step. But there is no doubt that SWIFT and the way that cross-border payments happen today is really impacting a lot of emerging market economies in terms of their ability to do business.
Yeah, and you mentioned banks falling in line. So hypothetically, regulations shift and it might become sort of an opt-in model. Even to a slight degree, it's recommended that you offer some sort of stablecoin backing. How do you convince the risk-adverse banks to effectively include these type of stable coins and so forth, as it will definitely present some new type of evolving financial crime typologies as well?
I mean, they have to feel safe with the regulators, for sure. So that's one of the most important things. And the regulators sometimes need to catch up because it's not simple. But I think, most of it is about education. There's a lot of perception, as we kind of said at the very beginning of the podcast, the lack of safety around anything with a C in front of it, crypto, basically. But I think most of it comes from a lack of understanding of how to control the pitch and the risk associated with it. And I think once compliance managers and officers and heads are going through this transition at the moment where they're feeling like they have to understand it, and they will understand it. It's complicated, but it's not that complicated. All the principles are the same. It's just understanding what's coming through the blockchain and understanding those analytics. So I think the banks will come on board as the compliance officers come on board, and then they can explain it to the senior managers and all of that stuff. So
you think we're going to see new training programs for compliance, AML, sanctions specialists, and so forth to understand this type of technology better? And do you think maybe even the development and of AMLI will bring this type of typologies into the sort of mainstream banking scene and have expectations from a governance perspective?
For sure. I mean, it's a must. I mean, it is the thing that's holding banks back right now. There's this if you're at the very top of a bank, you're probably not going to have an awful lot of time to start looking at chain analysis for hours and things. So, the information's got to start with the compliance community and has to be pushed up the line. The compliance guys have got to start to feel comfortable with it, and they do have to learn in. So, we don't see that much out. It's probably a great business opportunity for someone to launch a chain analysis elliptic coin firm school or something, But as I say, the principles are no different, on the compliance side. It's just more about understanding the blockchain.
We'll see after this episode. Maybe somebody all of a sudden uses Lovable and some other few apps, and all of a sudden they create a product or a trading program aimed at just this as a consequence. Would be great to see, at least. And in terms of development, what would you say is the most transformative use case for stablecoins in the next few years? There's been talk about sort of hedging. There's been talk about putting it into a type of currency where you actually do offer quick liquidity, so fast transactions cross-border, again, hedging in terms of putting it into securities because you're worried about your own fiat valuation going down and so forth. But what's the most transformative one that you see working with this on a day-to-day basis?
I think the most transformative has to be business-to-business, cross-border trade and payments associated with it. So, we are seeing as I say, a big wave now of interest from whether it's logistics companies or marketplaces, commodities companies, generally import, export. Everyone has problems with cross-border payments. And as I say, I think it's the one area of the payments industry that really doesn't work well today. It's very slow. There's a lot of friction with it. You have multiple counterparties in any sort of transaction, all of which have some level of regulatory obligation. So, and it's expensive. That kind of part where the funds go in and out of emerging markets tends to be like really, really expensive, and banks make a lot of money from it. So I think it has to be cross-border payments.
Absolutely. Before we end the episode, we do want to dish out a few quick-fire questions for you. Are you ready?
As ready as I'm ever going to be, yeah.
Nice. Why should banks and financial institutions embrace stablecoin?
Because it's coming, and I think otherwise, EMIs and smaller institutions are going to eat your lunch, basically. We've seen what's happened in consumer banking with people like Revolut and Monzo, and I think the same could happen in the B2B space if they don't get on board.
What should compliance teams look for when beginning to work with stablecoins?
I think they've got to understand that the principles are basically the same when it comes to AML and financial crime. I think they've just got to focus on blockchain analytics and understanding these tools and what information and the power of the information that those tools can provide.
Which payments or services will see the most transformative change due to stablecoins?
Yeah, cross-border payments, emerging market to emerging market or developed world to emerging market. I think those are where the problems really lie.
And lastly, why does stablecoin adoption matter in the real world?
Because the existing cross-border payment platforms are not working. And I think it is stifling global trade. And I think if payment can happen quicker, then, there are all sorts of like perishable goods and all sorts of things that have a very time-sensitive payment requirement that, that problem can go away much easier. So, you could argue that stablecoin could really stimulate levels of global trade.
And that brings this spin of the laundry to an end. Chris, thank you so much for joining me. Where can people find and connect with you?
You can go onto our website, www.getorbital.com. I'm on LinkedIn, happy to link up. Hopefully my assistant can keep on top of it, but that's probably the best way. Yeah. Ask us a question and happy to get back to you.
And thank you for listening. If you have enjoyed this podcast, check out the back catalog of 7 seasons and more than 120 episodes, and follow The Laundry on your podcast platform of choice. We'd love for you to share the podcast on social media channels, tell a colleague about it, give us a 5-star rating, because it really does help people find us. What subjects do you need to cover? Comment on Strise LinkedIn, my LinkedIn, or email laundry@strise.ai. Your host for this episode was me, Fredrik. Our producer was Matthew. Our editor was Dominic. And our engineer was Nicholas. The Laundry is proudly produced by Strise. Visit strise.ai for more information. See you next time. Money makes a world go round. It makes a world go round. And thank you for listening. If you've enjoyed the episode...
The Laundry is proudly produced by Strise, your AML automation software for faster onboarding, smarter monitoring, and growth without overhead.